Welcome back to the Deep Dive. Today, we are opening up the financial structure of a company that has, well, undergone a pretty tectonic shift in the last few years, Apollo Global Management, ticker APO.
Yeah.
And if you thought Apollo was just, another heavy-hitting private equity firm, you really need to recalibrate your view entirely.
That's absolutely the core takeaway right off the jump. When we looked at the sources, the consensus wasn't just that Apollo is an alternative asset manager. It's explicitly a hybrid financial institution. It's really a completely different animal than its peers.
Right. And the mission for this deep dive is to understand the DNA of that difference.
Mm.
Before we dive into the structure, let's maybe ground ourselves in the Apollo philosophy. They're fiercely value-oriented, right? Always focused on downside protection.
That's their mantra. Purchase price matters. It screams discipline.
It really does.
It speaks to that deep credit and private equity DNA, focused on acquiring assets at a discount or with a significant margin for error. But the execution of that philosophy, it changed forever with one massive strategic move.
The Athene merger.
Exactly. The full merger with Athene, the retirement services company, back in January 2022.
Okay, so that merger is really the central axis of this conversation. Our goal today is to unpack this union, this creation of the Athene flywheel, and understand precisely how it created this proprietary source of capital.
And how that source fundamentally transformed Apollo's growth trajectory, how it stabilized its earnings, and really how it redefined its competitive positioning in the private markets landscape. It's a fascinating story.
It really is. Let's get into it.
Okay, let's start with the architecture post-2022. The firm is now explicitly built on two core, highly interdependent segments. You've got the traditional asset management segment, which manages capital for clients, institutional and retail.
The part we traditionally think of as Apollo.
Right. But the real structural innovation lies in that second pillar, retirement services, which is Athene.
So let's look closer at Athene then. What exactly does it do, and why is that business model so, well, transformative when you pair it with a massive asset manager like Apollo?
Well, Athene is a major player in retirement savings products. They specialize primarily in fixed annuities and other sort of guaranteed income products. Now, when Athene sells an annuity, they collect a premium up front from the policyholder.
Okay.
And in return, they promise to pay a defined stream of income years, maybe even decades, into the future. This obligation creates a massive, and I mean massive, an extraordinarily stable pool of long-duration
Liabilities they have to cover. And the regulatory requirements, they basically dictate that Athene must invest that capital immediately, safely, and efficiently to ensure they can actually meet those promises way down the road.
Precisely. And that's where the asset management segment, the traditional Apollo side, steps in. It's now the dedicated sort of captive manager for that enormous pool of Athene's policyholder capital.
An internal solution, fully aligned.
Fully aligned. It's an internal solution to a massive capital need.
Okay, so if Athene is the demand side, generating these liabilities, how does the resulting flywheel effect actually work in practice? Yeah. Can you describe the mechanics of this virtuous cycle?
Sure. The cycle kicks off with Athene gathering liabilities. They do this by successfully selling retirement products, helped by competitive rates and, importantly, strong credit ratings.
Right.
Those liabilities are instantly translated into assets that require management immediately. Then, Apollo's asset management deploys this vast captive capital, and here's the really critical competitive advantage. It's largely price-insensitive capital.
Okay, hold on. Why is that price insensitivity so key? I mean, competitors have to constantly chase institutional investors, right? And those investors are very demanding about fees and returns.
Exactly. Because Athene's primary constraint isn't necessarily maximizing the highest possible short-term return. Their main constraint is duration and safety. They need high-quality assets that match the long duration of their liabilities.
So they're not chasing tenths of a percent here and there.
Not in the same way. This means Apollo doesn't have to pay super high management fees to attract this capital internally, nor do they face redemption risks like a typical fund manager. It's essentially proprietary, relatively cheap, and crucially, permanent capital.
Permanent capital, that's the magic word here.
It lowers Apollo's cost of funding compared to any peer who's relying solely on external, often cyclical, fundraising.
And this deployment generates those dual financial outputs we're going to discuss later, those stable management fees and the investment spreads.
Right. And the success of that deployment then strengthens Athene's balance sheet, which allows them to offer even more competitive products, gather more policyholder liabilities.
And the whole cycle repeats. It really is the definition of a closed-loop system.
It is, and it's a profound structural advantage. It's virtually impossible for peers who only rely on, say, external partnerships with insurers to replicate this, because those partners can always walk away, right? Or demand better terms.
Apollo owns the entire value chain here.
They do, from origination of the liability to the management of the asset.
And the scale that's resulted from this strategy is just staggering. We're talking about the success manifesting in this permanent capital base. This isn't just about funds with a fixed lifespan anymore.
Correct. That term, perpetual capital, it refers to capital that doesn't have a finite end date. There's no mandate to return it to clients within a fixed term, like, a traditional 10-year private equity fund.
And how much are we talking about?
As of the second quarter of 2025, this perpetual capital reached $498 billion.
Wow. Nearly $500 billion.
Almost $500 billion. And that accounts for nearly 60%. 60 of their total assets under management.
Okay, think about that. For you as an investor looking at Apollo, 6 out of every $10 they manage is essentially locked in for the long term.
Exactly. This provides an unparalleled level of stability. It removes arguably the single largest operational headache for any asset manager, that cyclical need to constantly raise new funds and worry about clients pulling their money out during market downturns.
The flywheel just keeps feeding capital in, almost regardless of market sentiment.
Pretty much. It ensures capital flows.
Okay, so that stable internal capital base has truly fueled some explosive scaling. Let's talk about the sheer growth velocity in their assets under management, their AUM.
Yeah, the growth rate is exceptional, especially when you consider the starting point. Apollo has seen its AUM expand nearly fivefold. Think about that. 5 times bigger.
From when?
From $170 billion at the end of 2015 to a staggering record of $840 billion as of June 30, 2025.
$840 billion. That velocity, that translates to what, year over year?
A 21% year-over-year increase, largely sustained by that constant feed from Athene.
And they're not running on empty either. They still have firepower left.
Not at all. As of Q2 2025, they maintain $72 billion in dry powder. That's uncalled, committed capital, just sitting ready for future investments across their credit and equity strategies.
Which gives them immense optionality, right?
Yeah.
Especially to capitalize on market dislocations, which fits perfectly with that purchase price matters discipline.
Absolutely. They can be patient and strike when prices are right.
So where does that $840 billion actually sit? This breakdown seems vital because it really reveals Apollo's true focus today. I mean, while they started as a PE firm.
Their scale today is overwhelmingly dominated by credit, or what they call their yield strategy.
Credit isn't just a major segment. It sounds like it's the defining characteristic of modern Apollo.
It absolutely is. The credit segment commands $690 billion in AUM.
$690 billion out of $840 billion total.
That's right. To put that in perspective, that's approximately 82% of the entire firm's total AUM. This dominance positions Apollo as basically the world's largest alternative credit manager, period.
Okay. And given that the vast majority of this capital is backing Athene's liabilities, those annuity promises the quality of that credit portfolio must be absolutely paramount. They can't afford to take high-risk bets here, surely.
They absolutely cannot. That's why the sources really emphasize the focus on quality. Over 60% of that huge $690 billion credit AUM was rated investment grade as of March 31st, 2025.
Investment grade. So relatively safe debt.
Right. This focus on high-quality debt is non-negotiable because those assets must generate stable cash flows to reliably meet the long-term fixed obligations promised to the annuity policyholders. They're chasing spread income, primarily, not speculative capital appreciation.
So that's a really crucial distinction. Okay, but let's look at their other segments. What about their traditional roots in private equity? Where does that fit in now?
Well, the equity strategy, it manages about $150 billion AUM. It's still core and actually highly successful. This is where their traditional deep value private equity approach lives, but it's also expanded significantly.
Oh, so?
It includes their flagship private equity buyout funds, sure, but also newer, more innovative strategies like hybrid value and secondaries, which they call S3.
Okay, can you elaborate on those two? What exactly is hybrid value?
Hybrid value is interesting. It's a strategy that sort of bridges the gap between traditional debt and equity. It often involves providing structured capital solutions, things like preferred equity or maybe subordinated debt to companies that are undergoing some kind of transition or seeking liquidity, but maybe don't want to sell a controlling stake.
So more flexible capital.
Yeah, it's designed to provide equity-like returns, but crucially, with debt-like downside protection, which, again, fits perfectly with that purchase price matters ethos.
Always protecting the downside.
Ah.
And S3, the secondaries platform, what's that about?
The secondaries business, S3, it focuses on acquiring existing interests in private funds or sometimes entire portfolios of assets from other institutional investors.
Ah, okay.
In the current difficult exit environment, which we'll definitely discuss later, S3 is proving to be a hugely valuable liquidity provider. It allows institutional clients, LPs, to sell their stakes in otherwise illiquid assets.
Makes sense. And finally, their commitment to tangible assets, real assets. How big is that?
Real assets currently stands at about $46.2 billion AUM. This segment is strategically focused on highly relevant, long-term trends. Their specialties include core infrastructure, real estate, both debt and equity, and sustainable investing.
So things like data centers, renewables.
Exactly. They're actively positioning these platforms to finance the enormous capital needs associated with what some call the global industrial renaissance. Think data center capacity expansion, renewable energy transmission infrastructure, modern logistics facilities. They're leveraging their credit scale to be a primary financier of the physical economy.
Okay, now, we established the sheer volume of capital. They manage $840 billion. That requires an almost unbelievable pace of deal flow, doesn't it? How do they ensure that deployment velocity? I mean, they can't just sit around waiting for bank auctions to happen.
That's absolutely right. You can't passively manage $840 billion, especially not the $690 billion credit machine, which needs constant, massive asset sourcing. The solution lies in proprietary origination.
Meaning they source deals themselves.
Yes, and more than that. Apollo operates 16 proprietary origination platforms. These aren't just, sourcing relationships. These are dedicated operational entities that they often own and control, designed specifically to structure investments directly.
So they're not just buying off-the-shelf loans or bonds. They are effectively building the assets or the debt instruments themselves to fit their needs.
Exactly. They are buying or building the factories that produce the specific types of assets required to match Athene's liability structure. This gives them a crucial competitive edge, especially in the crowded private credit market.
I was hooked.
It allows them to control terms, pricing, and structure much more effectively. They can tailor the investments, thereby better matching the specific duration and safety needs of the insurance capital backing it. They are, in effect, manufacturing investment-grade private debt at scale.
Okay, let's shift our focus now to the financials, because this is really where the integrated model manifests its value. And it fundamentally changes how analysts, and you listening, must look at Apollo. Traditionally, alternative asset managers had, two main income streams, but one was always pretty volatile, right?
Correct. We really have to delineate the old world from the new Apollo. The traditional streams were Stream 1, management fees. Predictable recurring fees, forming the basis of what they call fee-related earnings, or FRE, usually charged as a percentage of AUM.
Steady bedrock.
Right. Then Stream 2 was performance fees, or carried interest, the typical 20% of profits earned, but only after hitting a specific hurdle rate, usually around 8%. This carried interest is inherently volatile and lumpy. It's tied directly to market valuations and, crucially, successful asset sales or exits.
So if you invested in Apollo, say, a decade ago, you were largely making a cyclical bet on the timing of those big asset sales and those lumpy performance fees. But the structural shift driven by the flywheel has kind of inverted that reliance, hasn't it?
It's a complete inversion. The business model has shifted its reliance dramatically towards stable, recurring income streams. Let's look at the two key metrics of stability they now champion.
Okay, starting with fee-related earnings, FRE, that traditional stable stream. How's that looking?
FRE continues to show consistent, really impressive growth. It hit a record $627 million in just the second quarter of 2025. That's a 22% year-over-year increase.
Pretty solid growth.
Very solid. And the scalability is also impressive. The FRE margin expanded to 57%. Importantly, management fees, just from the highly scalable credit business alone, rose 25% year-over-year in that quarter. So this demonstrates their core asset management business is growing quickly and efficiently.
Okay, that's FRE. But the truly transformative element, the game changer, is the second massive stream of stability that Apollo now owns outright. Spread-related earnings, or SRE.
SRE is the direct financial consequence of the Athene merger. To really get your head around this, SRE is essentially the profit margin that Athene earns.
The insurance profit.
Exactly. It's a net investment income earned on the assets backing those retirement products, minus the cost of funding, meaning the interest they have to pay to policyholders, and also minus operating expenses. In Q2 2025, SRE was $821 million.
Wow, $821 million in one quarter. That is nearly $1 billion in income generated purely from their ability to successfully match those long-term liabilities with high-quality, long-duration assets.
That's it. SRE represents this huge, highly predictable stream of insurance profit margin that was simply inaccessible to Apollo as a standalone asset manager. It's almost like a utility-like income stream, very stable.
So if we look at the combined stable metrics, FRE from the asset manager and SRE from the retirement services side, this gives us the clearest picture yet of their sort of de-risk earnings profile.
Absolutely. You combine those. FRE plus SRE generated $1.4 billion in stable earnings in Q2 2025 alone. This figure is critical because it represents a structural de-risking of Apollo's overall profile.
A fundamental shift.
A fundamental shift from being maybe more like a venture capitalist making sporadic big wins to running a highly scalable financial utility with almost guaranteed predictable income streams.
We can contrast this newfound stability with the firm's historical reality, right?
Yeah.
Particularly in its GAAP metrics, which were subject to some pretty wild swings based on market sentiment.
Oh, yeah. The historical volatility of accounting metrics like return on equity, ROE, is really striking, and it perfectly illustrates this shift. ROE swung dramatically from a fantastic 48.1% in 2021, which was a peak market year,
Right.
all the way down to a negative 30.2% loss in 2022, when valuations corrected sharply across the board. That kind of volatility is typical when your earnings rely heavily on mark-to-market fluctuations of private equity portfolios.
A 78 percentage point swing in 1 year. That tells you everything you need to know about the lack of visibility those traditional GAAP metrics offered for this kind of business.
It really does. And it highlights exactly why the non-GAAP metrics, FRE and SRE, are now the most instructive for assessing the core operating health of the firm. The whole investment thesis has entirely shifted.
From what to what?
From timing market cycles and PE exits to judging the scalable, almost annuity-like growth powered by that capital deployment velocity from Athene. They're now being judged more on their ability to consistently execute their credit strategy at scale, not just their private equity genius.
Okay, so the engine is running, this flywheel, but it requires constant fueling, right? Let's discuss how Apollo is aggressively acquiring the factories, those origination engines, to feed Athene's massive capital base and maintain that crucial deployment velocity.
Yeah, this M&A strategy isn't just opportunistic, it's really a calculated vertical integration effort. It's focused almost solely on securing proprietary deal flow. They are using their own corporate capital to buy or build captive asset sourcing capabilities.
Can you give us some tangible examples of these acquisitions, say from 2023 to 2025?
Sure. A major move was the acquisition of Bridge Investment Group in September 2025. This immediately scaled up their real estate equity platform, but critically, it also added massive capacity to their real estate credit origination.
Ah, feeding the beast.
Exactly. This deal alone is expected to contribute something like $100 million annually to FRE starting in 2026. So, this isn't just about buying buildings, it's about sourcing real estate debt that is suitable for Athene's balance sheet.
And their moves into digital infrastructure that seems very forward-looking, focusing on major secular trends.
Absolutely. To capitalize on the exponential growth being driven by AI and cloud services, they acquired an IT solutions provider called Trace3 and also took a majority stake in Stream data centers.
So they're not just investing in tech stocks like everyone else.
No, they're positioning themselves to finance the physical hard assets, the massive data centers, the fiber networks that actually underpin the technology boom. This provides the long-duration, high-quality debt that fits Athene's mandate perfectly.
They also built their own massive asset-backed financing arm from scratch, didn't they?
Yes, they did. That was ATLA's SP Partners, launched back in February 2023. It's focused on complex asset-backed financing, and it acts as their largest internal proprietary origination platform.
Wow.
And furthermore, in early 2025, they formed a $3 billion financing partnership with Standard Chartered Bank, specifically focused on infrastructure and clean energy projects, particularly in emerging markets.
The common thread is always proprietary sourcing and structuring of long-duration debt.
Always. Control the origination, control the asset characteristics.
Okay, now let's talk about what management calls the third leg of the stool, which they view as paramount, expansion into the global wealth market.
Hmm.
Talking individual investors here.
Yeah, CEO Mark Rowan calls the provision of guaranteed retirement income products for individuals the holy grail. The goal here seems twofold. One, diversify their capital sources beyond just institutional LPs and Athene, and two, capture that massive global demographic shift towards retirement planning.
They're building a global distribution machine aimed at democratizing access to private markets for regular people.
That's the idea. And that distribution is scaling really quickly, which indicates there's immense demand from individuals for these kinds of products.
How quick?
Well, their global wealth business attracted $9 billion in inflows in just the first half of 2025.
$9 billion in 6 months.
Yeah. And to manage this influx, they've launched specialized products designed to fit regulatory requirements across different geographies. For instance, there's the Luxembourg-based Apollo Private Markets Psyche, launched in May 2023.
Okay.
And more recently, new Evergreen European Long-Term Investment Funds, or LTIFs, launched in September 2025 under the updated, more flexible 2.0 regime in Europe.
So for you listening, the key thing about these funds, Psyches and LTIFs, is that they're vehicles designed to provide individuals with periodic liquidity, maybe quarterly or semi-annually, unlike traditional closed-end funds which lock your money up for years.
Exactly right. It makes illiquid private assets more accessible and, frankly, more palatable to the retail client who values having some option to get their money back.
They're meeting individual investor demand for private asset returns, but trying to solve the liquidity problem.
That's the challenge they're tackling.
Okay, stepping back a bit, Apollo is operating within what seems like a tremendously favorable industry environment, supported by some enormous secular tailwinds.
Oh, the structural shifts are undeniable. First, you've got the public to private shift. We see institutional and individual capital steadily moving away from often low-yielding public markets into alternatives. The private market is projected to grow to something like $65 trillion by 2032. Massive growth.
Huge.
Second, there's bank disintermediation. Post-2008, regulations forced commercial banks to really retrench from complex or long-term lending. This created a massive void in the market.
A void that Apollo's private credit machine is perfectly positioned to fill.
Perfectly, they stepped right in.
So how does Apollo's unique integrated model stack up against its largest peers like Blackstone, ticker BX, and KKR, especially given Apollo's huge concentration in credit?
Well, the industry seems to be separating into maybe two camps. Blackstone, for instance, employs more of a diversified supermarket approach. They aim to be a top-tier player across huge franchises in private equity, real estate, and credit. Very diversified.
Cool.
Apollo, conversely, is the deeply integrated specialist at scale. Their key distinction is that sheer dominance of credit, remember 82% of AUM, and the full captive integration of the insurance wrapper through Athene.
That concentration really is the biggest differentiating factor, isn't it?
It is. Apollo has consciously chosen to dominate a single, massive, vertical private credit integrated with insurance. They're accepting a higher concentration risk in exchange for the significant competitive moat provided by that Athene integration.
How does that compare concentration-wise?
Blackstone is far more balanced, maybe around 34% credit AUM last I checked, and KKR roughly 43%. Apollo's entire strategy is fundamentally built on the belief that the stability and scalability of insurance-backed credit deployment outweighs the risk of that concentration. It's a big bet, but a calculated one.
Okay, that integrated structure gives them stability, sure, but it certainly doesn't eliminate risk. Let's look at some of the headwinds, starting with the macroeconomic environment, this higher for longer interest rate regime we're in. It seems to act as a kind of dual-edged sword for Apollo.
Yeah, there's definitely a tension there, particularly for the traditional private equity business. On the negative side, obviously, elevated interest rates significantly increase the cost of debt used for leveraged buyouts.
Makes buyouts more expensive.
Right. This tends to compress valuation multiples and slow down overall M&A activity. That hurts the traditional lumpy carried interest side of the business because private equity exits become harder and slower.
But the positive side, for their now dominant segments, must be far more influential, right?
For their integrated core, it's arguably a massive turbocharger. Higher base rates allow Athene to earn a better net yield on newly originated investment-grade debt. This directly improves the net investment spread, which boosts their spread-related earnings, SRE.
So higher rates are good for the insurance side?
Generally, yes, for new investments. So While the macro environment causes friction in the old PE business, it actually acts as a tailwind for the integrated credit and retirement business, which, as we've established, is now the primary growth engine.
Okay, interesting trade-off. Now, we've seen a pretty challenging exit environment recently, a slowdown in IPOs and M&A, which has created this global logjam of unsold companies
Yeah.
sitting in private equity portfolios. How does Apollo manage to turn this apparent negative into, well, a paradoxical opportunity?
They cleverly leverage the illiquidity in the market. The lack of easy exits means that institutional investors, the LPs and funds, often find themselves needing to rebalance their portfolios or raise cash, but they can't easily sell their stakes in these illiquid private funds,
Right, they're stuck.
which drives intense demand for Apollo's secondaries platform, S3. They are positioned perfectly to provide exit solutions, either by buying stakes directly from LPs or by funding things like continuation funds for other general partners who need more time or capital.
And this market illiquidity also helps their global wealth expansion push, doesn't it?
Absolutely. When traditional closed-end funds are completely locked up and illiquid, Apollo's newer semi-liquid evergreen products, like those European LTIFs we mentioned, become significantly more attractive to individual investors who value having at least some option for periodic redemption.
So the market's pain point lack of liquidity becomes Apollo's key distribution advantage for these newer products.
Precisely. They're offering a solution.
Okay, let's confront the elephant in the room. Concentration risk. That 80% plus concentration in credit means they are disproportionately exposed to what specific kind of systemic shock?
Well, the big one is a systemic downturn in credit markets, particularly a widespread wave of corporate defaults or maybe a sharp decline in the values of asset-backed loans. This risk is complex because it would hit both sides of the hybrid firm simultaneously.
How so?
Well, obviously, it would reduce the asset manager's performance fees from credit funds, but far more critically, it would directly pressure the stability and solvency of the Athene balance sheet itself, which holds that vast portfolio of debt assets.
And if Athene gets downgraded?
Exactly. A downgrade in Athene's credit rating due to rising asset risk would severely curtail its ability to sell new annuities, choking off that flow of new capital.
And this highlights what you call the unique flywheel friction risk. The interdependence is the source of strength, but it's also the source of this complex, potentially cascading risk.
That is the ultimate interconnected risk. The strength is the integration, but integration means a failure or serious issue on one side immediately impacts the other. For example, if there's a sudden, severe regulatory constraint placed specifically on insurance asset managers. Or maybe if a major reputational issue sharply curtailed Athene's annuity sales, that would immediately starve the asset management business of its primary low-cost capital source. The deployment velocity would slow dramatically, and the entire enterprise could potentially enter a negative feedback loop. That synchronization is definitely a double-edged sword.
Something investors need to watch closely. Let's pivot to governance, which saw a major strategic cleanup following the merger. They converted to a traditional C corporation, but the key move was eliminating that multi-class share structure, wasn't it?
Yes, this was a non-negotiable, absolutely essential step for their long-term growth and acceptance by the broader market. They adopted one share, one vote, which is widely considered the definition of best-in-class corporate governance.
Why was that so important? It sounds technical.
It was crucial to make the stock truly investable for index funds, ETFs, and major institutional investors. Many of these passive investors have strict mandates against holding shares in companies with unequal voting rights.
Ah, so they literally couldn't buy Apollo before.
Many couldn't or wouldn't. This change meant they could finally be included in major indices like the S&P 500, which was a huge milestone.
So this governance change wasn't just window dressing. It was a fundamental strategic move aimed at lowering their long-term cost of capital and vastly increasing their potential investor base.
Exactly right. Inclusion in major indexes guarantees a certain level of passive capital inflows, which boosts liquidity for the stock and can reduce price volatility over time. It was a mature step away from the old private partnership structure.
Okay. And finally, we should briefly note the regulatory environment. We saw that industry-wide investigation and the resulting $8.5 million SEC settlement back in January 2025 regarding the use of off-channel communications, like personal texts for business.
Yes, that affected many firms. And beyond regulatory fines, there's the ongoing issue of reputational risk, which can stem from private equity ownership in highly sensitive sectors. We've seen outside stakeholder groups criticize Apollo's ownership of certain hospital systems, for example, with allegations that a focus on profit led to service cuts or layoffs. These non-financial risks are just part and parcel of operating at this massive scale, and they demand constant management attention to public perception and stakeholder relations.
Okay, so given this complex, hybrid, credit-heavy, highly integrated model, traditional valuation metrics like a simple price-to-earnings ratio, I think you said it's currently sitting around 23.4x on a trailing 12-month basis. They seem pretty insufficient for a proper analysis, right?
They are fundamentally misleading, I would argue, because they fail to adequately capture the stability and the sheer size of that SRE income stream from Athene. Trying to value Apollo like a pure volatile private equity shop will almost certainly lead to
That's
misvaluation.
the better approach.
The only truly sophisticated approach, and the one analysts increasingly use, is a sum of the parts analysis, or SOTP.
Okay, walk us through that SOTP logic. How should we be thinking about valuing the two main parts of the business separately?
Well, you value the asset manager component primarily on a multiple of its stable fee-related earnings, PFRE, because FRE is highly predictable and scalable. You might apply a multiple similar to other high-quality asset managers, maybe somewhere in the 20x to 30x range, depending on your growth assumptions.
Okay, that's part one.
Then you value the retirement services piece, Athene, on a multiple of its spread-related earnings, PSRE, or perhaps on a price-to-book value basis. Here, you'd apply a multiple closer to what you'd see for a high-quality, well-capitalized insurance company or financial institution, typically lower multiples than asset managers, reflecting the balance sheet risk, but highly stable earnings.
And then you just add those two derived values together.
You add those two parts together to get an implied total value for the entire firm. That gives you a much more nuanced picture.
But despite this clear improvement in earnings quality and stability, the sources suggest Apollo still trades at a discount relative to peers like Blackstone and KKR. Why is that?
It generally does, yes. The market still seems to be applying a bit of a conglomerate discount. There's complexity involved in analyzing and managing two distinct, heavily regulated financial businesses, one an asset manager, one an insurance company, under a single roof.
So complexity and maybe perceived regulatory risk.
I think so. That introduces analytical complexity and perhaps some perceived regulatory risk overhang, making some investors hesitant. Coupled with that heavy concentration in credit we discussed, this complexity likely leads to a valuation discount compared to more diversified peers like Blackstone.
So the key then to unlocking a higher valuation, to closing that gap, lies entirely in management's ability to execute this flywheel strategy consistently and prove its worth.
Precisely. The ultimate catalyst for a higher multiple, for closing that discount, is management consistently proving two things. First, demonstrating resilience through a full credit cycle without major hiccups. And second, proving that the Athene flywheel creates tangible, measurable synergies.
They need to show the combined entity is inherently worth more than the sum of its independent parts would be.
Exactly. If they can maintain scalable growth powered by that cheap proprietary capital from Athene and navigate credit cycles well, that valuation discount should narrow significantly over time.
Okay, let's just quickly summarize again the powerful long-term secular trends that seem to support Apollo's aggressive strategic direction here.
Right. We see maybe four powerful forces really converging that seem to validate this credit and insurance focus. First, the global retirement crisis, which drives immense structural demand for guaranteed income products. That's Athene's bread and butter.
Yeah.
Second, the public-to-private shift, which continues to funnel capital towards alternatives generally, providing broad industry tailwinds. Third, bank disintermediation, which, as we detailed, is the fundamental market opening that created the opportunity for their massive private credit business in the first place. And finally, what management often terms the global industrial renaissance. This refers to the huge capital demand necessary to finance digital infrastructure, AI capacity expansion, supply chain reconfiguration, and the energy transition, all areas where Apollo's specialized origination platforms are explicitly designed to source long-term debt investments. Hashtag outro about.
Well, this has certainly been an in-depth exploration of a major financial transformation. Apollo is clearly no longer just a private equity firm. It is, as you said, a global credit and insurance powerhouse built on nearly $500 billion of highly stable perpetual capital.
Yeah, they've achieved immense scale. They've structurally stabilized their earnings profile in a profound way, and their strategic focus now seems crystal clear. Maximizing deployment velocity by acquiring or building every possible origination engine necessary to feed that huge captive capital base from Athene.
Which brings us nicely to our final provocative thought for you, the listener, to consider. Apollo has announced some staggeringly ambitious plans. They've committed to invest up to $100 billion in Germany alone. They're executing major moves into financing digital infrastructure globally. The scale is massive, the integration is complete, but the fundamental question remains.
Can the firm's proprietary origination platforms continue to source enough high-quality, long-duration assets quickly enough to keep that $498 billion perpetual capital engine running efficiently? And can they do it without sacrificing the firm's core philosophy of disciplined downside protection?
That really is the ultimate balancing act, isn't it? Scale versus discipline.
How fast can you grow while still ensuring that purchase price matters remains the defining principle? That's the multi-billion-dollar question.
We'll leave you with that thought. Talk to you next time on The Deep Dive.